Joining me now is Art Hogan, Chief Market Strategist for B. Riley Wealth Management. Good morning.
Good morning.
It's great to have you on the show this morning. Now let's just dive into this. So Jerome Powell signaled that we could see a rate cut in September. While this would of course be a huge news, have investors already been pricing this in?
Yeah, that's an excellent question. I would say that if you look at the Fed Fund Futures or the CME FedWatch tool, the consensus really has been that the Fed's going to cut in September, and I think that's been driven by the fact that we've got better or improving inflation data in the second quarter versus the first quarter. So for the first time in a cycle, there's nearly 100% chance, according to Fed Fund Futures, that they cut in September, which is the largest percentage we've seen throughout the entire cycle. And I think that the Fed will have plenty of information by the time that they meet on September 18th to make that decision. And I think that that's going to be the start of a trend where we have 25 basis points at least every quarter for the next 18 months to eventually get the Fed funds rate down to, call it 3 3/4 to 4%.
And let's say the Fed does begin cutting rates in September. Do you anticipate that we could end up seeing 2 or possibly 3 cuts by the end of 2024?
Yeah, I think the interesting setup for the Fed is at both the September meeting and the December meeting, they'll be disseminating more news. They put out what's called the Summary of Economic Projections, so we'll get a fresh update from all 18 of the FOMC members as to where they think monetary policy will be, inflation, GDP growth. So they have more news to share with us at those meetings. So we think that both the September and December meetings, they will likely cut by 25 basis points, and that'll be the start of a trend where for most of 2025, we're going to see a rate cut at least once a quarter.
And we'd be remiss if we didn't mention, of course, the presidential election just 3 months away. Now, the Fed has previously said that it's politically independent, but do you believe that policy decisions and other related Fed speak will sway voters over the next 3 months?
No, it's hard to say that a 25 basis point cut in monetary policy with long and variable lags is going to have an immediate impact, or certainly an impact on the economy, before the November 5th election. So I think it's safe to say all of the meetings for the rest of this year are live. I don't think the Fed has to worry about swaying public opinion or political opinion whatsoever. I just think they need to start after having kept rates at 5.25 to 5.5 for the last year. It's time, and inflation is certainly working in the direction. They've made significant progress towards their goals.
And of course, the Fed decision is the major economic headline of the week so far, but more news is coming out this week. The July jobs report drops on Friday morning. So what do you think investors are looking out for here, and how much do you think this will impact the Fed's mindset?
Yeah, I think we want to see a continuation of the normalization of jobs creation. So in the first quarter of this year, on a 3-month average basis, we were creating about 250,000 jobs a month, and that's worked its way down to about 175,000 jobs a month, or thereabouts, on a 3-month average. So I think that's the perfect number, somewhere between 125 and 175,000 jobs a month, to keep unemployment or keep employment full. I think the one wild card that may come in, and this came up in the press conference, is if in fact the unemployment rate ticks up to 4.2%, there's a technical rule called the SOM rule that actually is a recession indicator. There was a question during the press conference, and Jay Powell pushed back on that and said that, listen, most of the recession indicators haven't been very good in this cycle. But that's one of the wild cards on a sleepy Friday afternoon in the summertime that might cause some volatility.
And another major item this week is obviously earnings. So how are investors pricing this out as data rolls in?
Well, I'll tell you this, the start of earnings season, at least as it pertains to the mega caps, was pretty sloppy with both Tesla and Alphabet, but that seems to have calmed down a bit. And I think the real theme amongst the hyperscalers has been that if you can tell us what you're going to do with artificial intelligence, how you're going to actually drive revenue growth, if you can show us that this CapEx is actually worthwhile and will have a return on investment, companies have been rewarded. So we saw that last night with Meta. We'll likely see a similar effect with both Apple and Amazon after the close tonight. But it was pretty choppy a week ago, and we certainly had a significant sell-off in the technology and communication services. That seems to have stabilized, and we'll see how Apple and Amazon do after the close tonight.
A lot to look out for. Thank you so much for joining us today.